And welcome to this latest episode of the Bull and the Bear podcast. I'm your host, Matt Clark with moneyandmarkets.com, and we'll be bringing in our Money and Markets contributor, Charles Sizemore, and Chief Investment Strategist, Adam O'Dell, here in just a second. But to get through some housekeeping first, you can catch the podcast on Apple Podcasts. We're also on Google Podcasts. We're on Spotify. We're on iHeartRadio, and about 20 other syndicators that I really couldn't name at this point. So I'll just kind of get to the big ones. But any way you listen to us is great. We certainly love that. Leave us a review, leave us a comment. We love your feedback as well. And if you do have a specific question, maybe you'd like Adam or Charles or myself to address, or maybe a stock you'd like us to talk about, or a sector you'd like us to discuss, then email us. You can email us at thebullandbear@moneyandmarkets.com. We'll put the email address right down here whenever we're finished, but you can check it. That's thebullandbear@moneyandmarkets.com. To get right into it, we won't waste any time. Last week we talked about, in terms of like the 4th of July, and picked out some all-America stocks, some stocks that are very American-based, very Americana, but yet have kind of a wide reach. So we kind of want to capitalize on that theme a little bit with what we're going to talk about today. And what I looked at when trying to prepare for this is, obviously, there's no question that in terms of the economy, we are in a recession. I don't think there's any way that you can argue against that. I think economically, all things point to we're in a recession. How long that lasts, that's another completely different thing. But in looking at trying to find a sector of stocks to kind of analyze today, I kind of thought, okay, what usually does well when the economy takes a downturn? And there are several. This is not just the only one. There are several. And the one I want to kind of talk about today is interesting in so much as that it involves everything, most everything that we need. There's a big difference whenever you go shopping, right? I mean, when you go shopping, there's needs and there's wants. I want this, or I need this. I want a TV. I need toilet paper. I mean, so you see where the contrasting difference is. So I wanted to kind of take a sector that involves what people need. And in stock market terms, if you're not familiar, that is normally referred to as it's consumer discretionary, or kind of in that mode. It's what consumers need, that they need to buy all the time, regardless of what the economic situation is, regardless of what your monetary situation is. There are things that you absolutely need, and these are essential items: clothes, household goods, things like that. They're not electronics. It's not a computer. It's not a television or something like that. Something that you just want to go out and buy just because you want to buy it. So I wanted to kind of to talk with both Charles and Adam about this particular sector. And as I did last time, I pulled out 3 stocks that are, and I did this specifically. I looked at the S&P 500 Consumer Discretionary Sector ETF. It's XLY, if you're wondering what the ticker is, and it holds some of the biggest consumer discretionary stocks, in the stock market. And just for a point of reference, in looking at this yesterday, it is very, very close, and I mean within $1.02-ish of its 52-week high, and since its March lows, it has jumped 61%. So it clearly shows the trend in where consumer discretionary stocks are going, and that is upward. So I found 3. These are all, I'll preface by saying these are all fairly good-sized companies. And these are all very well-known names, or at least for the most part are very well-known names. And I just want to examine, kind of look at those companies, what they do, and obviously then get into, okay, what do we think about that? Do we think that these companies are potential buy stocks for investors? Are they ones you want to stay away from? If you own them, is it good to hold them? Is it, I kind of want to run the gamut here in terms of what we talk about. And I'll jump right in and get to the first company. And it's a company that it's a merchandise retailer, which I know is vague. But they started out with clothing. Now they've expanded into the grocery market, and they have their own brand names and things like that. There's about 1,900 stores across the country that bear this label, and it's a company that's based out of Minneapolis, Minnesota, and it's Target. And there's Targets everywhere. I don't know of many large markets or at least, mid-sized markets that don't have a Target either in the community or relatively close by. So that's the first one. And we'll talk about their fundamentals and their technicals and all that here soon. But I want to first bring in Charles Sizemore, contributor for Money and Markets, and start with him. And then we'll bring in Adam O'Dell, our chief investment strategist, and he'll give his take. And again, let me preface all this by saying I gave both Adam and Charles these stocks yesterday, knowing that Adam doesn't need them the day before. And he made that very clear last week that he doesn't need them. He could do it in 5 minutes. I did it anyway, just out of a sense of fairness. I didn't want to seem like I was playing favorites by just sending it to Charles and not to Adam and putting Adam on the spot. So we'll first start with Target. Charles, first off, welcome back to the podcast. Hope you had a great week. Hope you had a great 4th. And let's talk about Target.
Sure, you bet. So I think with any retailer, you really have to start with 2 questions. What was the trend in their business before coronavirus blew up the world? And what do they look like in this coronavirus and post-coronavirus world? And so looking at Target, it's an everything store. You said they started with clothes and moved into groceries. I would just say it is an everything store. It's like Walmart. It's like Amazon.com. They sell pretty much everything. If you were to get locked into a Target store and have to live there for the rest of your life, you would be well fed and well clothed and well entertained for the rest of your life. I mean,
wasn't there a movie with that? The 2 people got
locked into a Target? Airport, wasn't it? Or no, maybe it was a Target. I don't remember. Yeah, there was something like that. Or maybe it was a Walmart. But yeah, I mean, you could assuming the security cameras never found you, you could just sort of hide, and live there for years and subsist before anybody noticed, right? So yes. Now, what was the bigger trend in Target prior to the world blowing up? And I would say Target is in elite company with Walmart and maybe Home Depot, in retailers that can compete with Amazon. And at the end of the day, I mean, it's just a slow battle of attrition with Amazon. I mean, they are slowly rolling over everybody because they do things quicker, cheaper, more efficiently, and it's easy, and so very few retailers can even hope to compete with them. Walmart and Target can, and part of it is they have this massive retail infrastructure in place. And so I would say, Target was a little bit slow. Walmart was a bit more ahead of the curve on this than Target. Target was catching up in a hurry. Those trends were in place before the world blew up. So that's good. Now, post world blowing up, Target was still looking pretty good. It was considered an essential retailer. So when lockdowns went into effect, Target still was able to keep their doors open, and they probably, this is debatable, we don't really have good data yet, but they likely increased their market share because a lot of their competition was closed. So why does that matter now? It looks like we're having a second wave, or maybe this is just a continuation of the first wave. It depends on who you ask. But if we do get a situation where, we go into lockdown again or semi-lockdown again, Target should do just fine. If we get into a situation where, we're just, wow, I just lost my earpiece. Did you see that? Did you see me almost catch the earpiece?
I saw that.
So I'm an earpiece down. I still got one in. So we're going to get through this. We're just going to tough this out. Never let them see you sweat.
You're a trooper.
I'm a trooper. So it didn't even lose my train of thought here. So if you do have lockdowns or whatnot, Target should be fine. If you don't have lockdowns, a lot of buying patterns are already established. We've taken to getting our groceries, at least some of our groceries at Target. We roll into the parking spot, they run out, dump it in your car, and you're on your way. I don't even have to go in the store anymore. So I'm going to continue doing that once the world gets more normal. So I think Target is in a really, really good spot. The stock is not cheap, strictly speaking, but I don't consider it wildly expensive, particularly in this market where everything's a little expensive. I actually really like Target. I think it's a good place to be right now.
Okay, so yeah, there's your take on Target. Adam O'Dell, I'll bring you in and have you give us your take and let us know where you're at with Target.
Sure. For me, Target's a buy. I'll get to that in a minute. I do want to preface kind of, there's a subtle distinction between the consumer discretionary sector and the consumer staples sector. Typically the consumer staples is considered the true essentials, things that you just have to have to get by in life. Whereas discretionary is more like if you have extra money at the end of the month and you want to splurge on something. More companies are in that, but more and more today, I mean, I don't really like to make too much of a distinction there because, today it's really hard to tell. Some companies sell both types of products, essentials and not essentials. Likewise, we do have, unfortunately, an income and a wealth gap in our country. So, even though we're technically in a recession now or going through a tough time, some people are hit really hard and some people still have plenty of discretionary income to spend. So I really do want to look at it as at a company by company basis, and that's why we're kind of looking at individual stocks here. For me, Target is a good long-term buy. I mean, it actually just triggered about 3 months ago a 3-month cycle 9 signal, which is basically a high probability signal that over 2 to 3 months that the stock is going to outperform the market, and in fact, Target has. It's in a longer-term uptrend, so that's good. When I run Target through my 6-factor green zone rating model, which looks at momentum and size, volatility, value, quality, and growth, Target earns a pretty respectable score of 82. So that means that if you look at all 6 of those factors and you look at all 8,000 or so rankable stocks, it's rating higher than all but 18% of the market out there. So obviously, Target is a huge company, so it's going to rate very lowly on size. Typically smaller companies outperform larger companies, but we have seen in this bull market the mega caps do really, really well. But really, where Target shines is in quality, the quality of its return on assets and return on equity. Its margins are very strong, better than all but 9% of the entire market out there, and then also on the risk-adjusted returns. So the returns that Target has given investors for the amount of volatility in the stock is rated 98.4. So really better than any stock you can get out there. I will say, if you don't like Target for some reason, you have other options. There are other kind of like big box discount, kind of get everything you want stores that rate just as highly in the 80s. So like for instance, Walmart rated 82 on my 6-factor model. Costco rated 82 also. BJ's rated 86. Of course, if you want to go with Amazon, that has an 85 rating. And then one store that I'll point out that has a better rating than all of them is Sprouts Farmers Market. So this is a grocery store. This is truly a consumer staples, not a consumer discretionary. Although some people would say that organic food at a place like Sprouts is somewhat discretionary. But just to show you, how the system works, Sprouts has a rating of 98.6. So really better than all but 1% of the market out there right now. And we actually made a play on this a couple months ago in Cycle 9 Alert. We were in the stock for less than 3 months. We made an options play on it for net profits of 60 to 70%. So really, I mean, that's a good short-term and long-term play as well. But you really can't go wrong with a lot of these big box stores right now. I think that most of their business models are solid. They're selling essential products and some discretionary products, so you really can't go wrong.
I actually like that when you said it's kind of a mix, and a company like Target, a store like Target, actually does both. It's got discretionary and it's got essential. I think that is an important point to play out when you're talking about a store like Target or like Walmart or something like that. And I'm kind of with both of you. I look at this and I see how it's performing against against the industry, and it's strong. I mean, it's up 37% compared to its 16% gain with the rest of its sector, and it continues to show strong signs of moving forward. So I think that the Target for right now for an investor, if it's something that you're interested in looking at, is definitely worth a harder look and maybe even an investment at this point. Moving on to our second company, that was Target. This next store it operates in 39 states, the District of Columbia, and interestingly enough, Guam. Not really sure why it pulls into Guam, but hey, if the market's there, that's fine. It's a company that's headquartered in Dublin, California. It's got about 1,800, a little more than 1,800 stores across the 39 states that it's in. It operates kind of off-price retail apparel, home fashions. It's basically kind of a discount store for those types of items, clothing and dishes, towels for your kitchen or your bathroom or whatever. It has those types of things, and they're typically they're brand names, but they're sold at a deeper discount than what you would pay for if you went directly to the brand or went to a larger store. And this company is Ross Stores Incorporated. It's trades under the NASDAQ as ROST. So it's Ross Stores. And it is, again, not, I wouldn't say it's necessarily the same as Target, although it is a retail company. It doesn't really necessarily sell the same exact things as Target. Target kind of has its own brands that it sells off at a lower price, whereas Ross does it a little differently. They take kind of the more expensive brands and find ways to discount them a little deeper. They don't really have their own brand that they sell. And plus, Ross does not do groceries that I'm aware of. They mainly just focus on home furnishings and apparel. So first, I'll start with Charles and get your take on Ross stores. Charles.
So a bit of World War II history. Do you remember what the Japanese seppuku suicide was, where the soldier, rather than face dishonor, would stab himself in the gut and then pull the sword up and gut themselves before their second would basically as a mercy blow cut off their head.
That is one of the most tragic segues into a conversation I have ever.
What I'm saying is, I would rather commit Japanese seppuku suicide than set foot in a Ross store.
Wow, that is a very strong statement.
I'm joking.
And colorful to say the least.
Kind of joking. No, I hate these junk stores. I really do. They're not a pleasant experience to go to, but they do serve a purpose. And I'm, all of my dark humor aside, that really is, they really do serve a purpose. And so Ross was actually doing really well before the world blew up. They got hit hard because they're a non-essential retailer. They sell clothing and accessories. They don't, you can never argue that getting a discounted polo shirt is an essential business. So they did get hit hard. That said, we are in a recession now, and a store like Ross is actually a really good anti-recessionary stock, because when times are hard, people are more likely to go look for, what's the word they use? It's not off-label, it's off-rack. An off-rack store like Ross, where you're getting oftentimes clothes that might be slightly damaged but still wearable, or perhaps it's leftover inventory from the previous year that they're trying to clear out. So when you've had a year like this, where consumer spending on things like clothes really went in the toilet for a while, you have excess inventory everywhere that presumably Ross is getting for cheaper than usual and able to resell at a decent margin. So I think going forward, Ross actually looks pretty good. I think I think they have a good. We have a lousy macro environment overall. I almost lost my earpiece again. Did you see that? But I caught it this time.
You are riding the struggle bus today, sir.
Well, I really need to get a new earpiece. But Ross is it's an overall bad macro environment for. I just lost it again. Can you believe this? I've got to get better equipment. This is embarrassing. Ross, it's a rough macro environment, but I think in the case of Ross, it's a really good environment for them. So I would say I'm a bull on the stock, but just never make me go to a store.
Understand. Adam, seppuku or harakiri aside, what is your take on Ross?
Yeah, I have a different take as far as the stock. Ross, whether you look at Ross or even TJ Maxx, I see the story as far as we're in tough times. And so maybe these discount retailers are going to appeal to people that are like pinching pennies or a little bit more on a tighter budget now. But frankly, Ross rates a 35 on my 6-factor model. So that would definitely not be a buy. Even TJ Maxx, one of its competitors and my 92-year-old grandmother's favorite store in the world, rates it a 42. So it's not also a buy. I'm sorry, grandmother. But, so basically, these are large companies. They have a large footprint in stores where the overhead is very high. They're not good values right now. They're overpriced according to my metrics. Their growth trends are below par. Their volatility of the stock is above average, and their momentum is below average. So it's just really a bad mix of factors that you really don't. You're not going to get market beating returns, in my opinion, from either of these two stocks, Ross stores or TJ Maxx. On the other side of things, like I said, where I do understand the argument that in tough times, discount retailers are going to do better. At the same time, I mean, like I said, unfortunately, we do have a wealth gap and an income gap, and this coronavirus has affected different folks differently. And we have millions of Americans out of work, and that's tragic. But we also have a lot of folks that are still doing just fine in their jobs if they're able to work from home, if they are essential workers, if they haven't been furloughed or laid off. And so, one stock within, if you're looking for a retail stock, if you're looking for a clothing stock, certainly Lululemon is rated very highly on my system. I know it's kind of a cult stock, so I usually don't go into those, but just to kind of give you an idea, Lulu's momentum is rated 96, so better than all than 4% of the market. Its risk-adjusted returns are rated 91. The quality of its book, meaning its return on assets and its margins, are rated 98, and its growth metrics are rated 82. So, even though a lot of folks are going through tough times, and that's tragic, and we really want the economy to be robust for everybody, right now there are still a lot of folks that have discretionary income, just like they had before everything, and they're ordering this type of athleisure clothing just as much as they were. So, Lululemon looks like a much better stock to me than Ross or TJ Maxx.
And can I jump in? I would actually agree with that. They had a lot of really good trends going for them before the world blew up, such as the trend towards athleisure, just basically wearing athletic clothes around town as if those are normal clothes. That was, they really were a trailblazer in that high end, athleisure, again, for lack of a better word. And what's interesting is, with everybody working from home now, with everybody with dress codes now completely flexible, I think I could go to the office in a toga and nobody would think it was strange anymore. There really are no rules. And I think rules are going to be very slow to come back once the world gets more normal. I think that's a stock that really does have a lot of wind in its sails. I think there's a lot of really good trends supporting it.
Now, I have to agree with Adam here, not to buck the trend from Charles, especially with his colorful intro into what his thoughts were about Ross. But the one thing that really stood out to me was the overvalue of Ross's stock. And I get that a large majority of the market at this point is overvalued. I think that's just, that's just been the nature of things. But in terms of comparison to the industry, I look at the ratios, and it's just, to me, it's untenable. I just can't see Ross as a quality investment. I mean, if you're looking for off rack, cheaper name brand clothing, great, that's fine. But in terms of an investment, I'm just not there. I think it's priced too high. I don't like where its momentum is right now. It's down 15%. It's not doing very well against the industry. All in all, I just think there's too many negative signs for Ross to make it a viable investment. Again, you want to buy clothes there, fine. I think that's great. That whatever you want, unless you're Charles and you don't want to step foot in it, that's totally fine. But in terms of an investment, if we're not talking about clothes, then I think this is probably one you want to stay away from.
Would you commit ritual suicide before buying the stock?
No. No. Why would you even ask that? I would have to stop short and ask, what is wrong with you? But I'm just going to let it go for right now. No talk of that. All right, moving on to the last company that I pulled. This one is quite a bit different from the first two, both from Target and from Ross. And this is a very big company in terms of its footprint, about close to 5,000 stores across the U.S., Puerto Rico, and the Virgin Islands. It also has an independently owned secondary brand that is in Mexico, the British Virgin Islands, and other places. It was founded in North Carolina. Like I said, it's a very, very big company. And it basically, I'll just tell you what it is, and you'll know exactly what market they're in. But it's Advanced Auto Parts. Its ticker is under the New York Stock Exchange under AAP. Obviously, they work with replacement automotive parts, accessories, batteries, other maintenance items that have to do with the car. I found this to be interesting just because we've talked a lot about the state of the economy, the state of people's personal ability to spend money. And, I think whenever you start, everyone needs a car or some mode of transportation to either get to and from work, to and from an interview, to and from, wherever. Sometimes, when your car breaks down, you don't have a lot of money, you're going to try to DIY. You're going to try to do it yourself, fix it yourself, as opposed to paying, however much you pay per hour to have a mechanic fix it or whatever. And typically in market downturns and in tougher economic times, stocks like Advanced Auto Parts do very, very well. Because of that, because sales typically go up exponentially in that time because more and more people are wanting to do it yourself. So I'll first turn it over to Charles, and please, I don't need an Asian suicidal ritual intro into this one. So if we could steer clear of that, that'd be great. But give me your take on Advanced Auto Parts.
Well, I might add that this may be another quirk, but I actually kind of like just browsing around auto parts stores. I don't know why. That's actually weirdly therapeutic to me. But looking at the stock, there's a couple things that I don't particularly like about this one. One, the company wasn't doing wildly well even before the world blew up. I would say if you are going to find a bullish case to be made for this one, it would simply be that with the world in rough shape for a while, you may have people postponing auto purchases for a while, needing more maintenance on older cars for a longer period of time. You may also have people avoiding public transportation for a while. So, that means they have to get around somehow. They may buy a used car that needs some work. So, I mean, that's a mild positive backdrop. The negatives are, of course, these guys don't sell anything that's particularly unique or special. Auto supply stores are a dime a dozen. They're now competing with online options like Amazon. It's a low margin business. There's just not a compelling reason to really buy this one. I would take a pass.
Okay. And Adam, give me your thoughts.
Yeah, I'm with Charles. I would pass, particularly on Advanced Auto, to kind of use his words. They are a dime a dozen. They don't sell a differentiated product. Just to give you some flavor from that, in years past when I would change my own batteries, when I had a battery go out, I would always have the hardest time remembering whether I bought a battery at Advanced Auto Parts or AutoZone. I would always invariably show up to one and say, all right, well, here, I'm turning in, I want the same one. And they say, well, it's the other store that you bought this at. So, I really can't tell the difference between the two as far as a shopper or as far as an investor doing research on the two companies. But I will say, if you proposed Advanced Auto, which rates actually fairly lowly on my 6-factor rating system, it rates a 56, so right in the middle of the pack, nothing too special. By contrast, AutoZone, which is ticker AZO, has an 87 ranking. And just to throw another one out there, I think it's regional. We don't have them in Florida, but O'Reilly Auto Parts is rated 83. So, if you really have to go out and add a stock to your portfolio that's an auto parts maker, I would go with AutoZone AZO or O'Reilly ORLY before I would buy Advanced Auto Parts. But ultimately, I don't see a strong case for really any of them. Maybe some people will be holding onto their cars a little bit longer and doing their own work, but ultimately, interest rates are extremely low right now, and all the car companies are offering major incentives to buy new cars. So, this is hard stock to get excited about.
And that's and I agree with that. I agree with both of you that right now I think that Advanced Auto is a pass. And to that end, I agree, especially with the point you brought up, Adam, about the auto market. You've got just very competitive dealerships and brands that are basically just throwing money at people to get them to buy new cars and to get them into the lot. And the incentives are unbelievable. The interest rates are so low that even in a difficult economic situation, it's very hard to pass up at least going and looking at a new car as opposed to trying to fix up the one you have, unless you're just absolutely in love with it and you don't want to part ways with it. And then I can understand. But yeah, I'm with both of you that Advanced Auto is a pass. So just to kind of review, in terms of target, I think we're all kind of on the same page that it's a good stock. It's one that, as an investor, if you want to look at it, it's certainly worth your time. With Ross, Charles, I'm going to say reluctant to shop, but maybe not so reluctant to buy. Adam and I are a pass on Ross, and then all three of us are a pass on Advanced Auto Parts. So that's a good look at those three. Again, if there's a particular stock or sector or anything like that you'd like us to look at, we're more than happy to. Just email us at thebullandbear@moneyandmarkets.com. And you can check out our podcast all the time on Apple Podcasts, Google Podcasts, Spotify. also on iHeartRadio. Check us out on YouTube. You can view us there. Just go to youtube.com and type in the Bull and the Bear podcast, and we're right there. You'll see all of our most current one, this podcast, as well as all the podcasts from before. Coming up on Wednesday, just kind of give you a bit of a tease. Charles is going to be back, hopefully without his samurai sword, and we'll be talking about dividends. What we're going to talk about with dividends, I'm not going to give away yet, but we are going to talk about some dividends. So you want to make sure you tune in for that. It's coming up on Wednesday, next Friday. Adam, Charles, and I are back, and we will go through and just find some surprises to talk about in terms of stocks in the market. So first off, I want to thank Charles Sizemore, Adam O'Dell for being on this Friday. Certainly appreciate your time and hope you guys have a great weekend. Look forward to talking to you guys next week. So for those two and myself, I'm Matt Clark. You've been listening to the Bull and the Bear podcast right here on moneyandmarkets.com.